You can use the exact same credit card to buy dinner on Swiggy and earn a 10% cashback return, then use it to pay your income tax and earn absolutely nothing. This introductory textbook diagram shows how most consumers think credit cards operate. It maps a simple line from the cardholder to the bank to the merchant. To understand where the money for your rewards actually comes from, you have to discard this model entirely. Treating credit cards as a three-party loop hides the entities that actually dictate the economics of the transaction. The accurate picture of modern digital payments is a continuous five-party loop. A single transaction relies on you, your issuing bank, a payment network like Visa or Mastercard, the merchant's acquiring bank, and finally, the merchant itself. To see exactly how reward points are generated, we need to track one purchase through all 5 of these nodes and watch who gets paid. Consider a standard 1,000 rupee payment for dinner at a local restaurant in Bengaluru. That payment is split into 2 completely separate financial events, separated by time. There is the authorization, which happens at the table, and the settlement, which happens the next business day. When you tap your card against the machine, you are initiating a pure exchange of data, 0 capital moves during this interaction. The authorization phase lasts about 1.5 seconds. Let's run a clock and track the data packet chronologically. This diagram breaks down the timeline. At 0 seconds, the card generates a one-time cryptographic token. Your actual card number is never transmitted. At 0.1 seconds, the terminal packages the token and amount, sending an authorization request to the merchant's acquiring bank. The acquiring bank acts as the invisible doorway connecting the local restaurant to the global digital payment system. The acquiring bank is the doorway to the global payment system. At 0.4 seconds, it forwards this packet to the payment network, Visa. By 0.8 seconds, Visa reads the token, identifies the path, and pushes the request to your issuing bank. At the 1-second mark, your issuing bank's algorithms run a fraud risk assessment and verify you have 1,000 rupees of available credit. Assuming the checks pass, the bank generates a unique alphanumeric authorization code. By 1.5 seconds, that code is sent back down the exact same chain. The terminal beeps, the screen turns green, and you walk out of the restaurant. Through that entire exchange, no bank transferred any actual currency. The merchant has no money, and your bank hasn't parted with any. What actually happened is that your issuing bank placed a 1,000 rupee reservation against your available credit limit. The 1.5-second window operates entirely to assess risk and reserve data. This perfectly sets the stage for the actual movement of capital. The physical movement of money begins the following business day, during the settlement phase. Transferring billions of tiny individual payments point to point between thousands of global banks would immediately crash the system under the sheer volume of transactions. Instead, the network uses multilateral netting. The network aggregates all transactions. If Bank A owes Bank B 52 crore and Bank B owes Bank A 47 crore, they don't send individual payments. They simply settle the 5 crore difference with one single transfer. Your issuing bank transfers its net obligation to the network, which subsequently distributes the funds to the appropriate acquiring banks. Finally, the acquiring bank deposits the funds directly into the local restaurant's checking account. But for your 1,000 rupee dinner, the restaurant's account is only credited with about 980 rupees. That 20 rupee gap is the structural fee that pays for the existence of the entire 5-party global architecture. The industry term for this missing 20 rupees is the merchant discount rate, or MDR. The MDR is split into 3 highly specific slices among the system operators. The acquiring bank takes the smallest cut, about 1 to 3 rupees, to cover the cost of the physical terminal and basic processing. The payment network takes an assessment fee of 2 to 3 rupees for their routing infrastructure. Your issuing bank takes the vast majority, roughly 14 to 16 rupees. This interchange fee compensates the bank for carrying the actual credit and fraud risk. A fraction of the interchange fee funds your reward points. These points are a mechanical redistribution of the merchant's fee, not a bank's gift. Because reward points are derived directly from the MDR, the rate you earn varies drastically depending on the category of the merchant. This graphic illustrates the breakdown by sector. Notice that restaurants have high margins and can absorb an MDR of up to 2.5%. That large fee generates a large interchange, which funds the highest reward rates on your card. Compare that to fuel stations, where margins are razor thin and the MDR is capped near 0.5%. For government payments, the mandated MDR is strictly zero. If a category does not generate a high MDR, there is no interchange fee to share. It is mathematically impossible for a bank to sustainably fund high rewards in those sectors. The merchant fee underwrites an instantaneous risk management network. Reward points are simply the most visible byproduct of that infrastructure. Zero-fee, real-time payment systems like UPI have rapidly gained market share in India. UPI is highly efficient for moving money directly between bank accounts, but because it operates without an MDR structure, it lacks the capital to fund consumer reward programs. More crucially, the MDR pays for a robust system of chargebacks and dispute resolution that direct bank transfers inherently lack. This diagram maps out the dispute process. If a merchant fails to deliver a product, the dispute flows backward through the network, forcing the acquiring bank to retrieve the funds from the merchant. Because your issuing bank holds the capital risk for the transaction, their financial incentives are perfectly aligned to act as your advocate during a dispute. When you top a credit card, the hidden fee pays for a global safety net, establishing the five-party system as a robust architecture for high-value commerce.